Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and in today's video, we are talking about some stocks that could literally double your money in a very short amount of time, which could surge up 90% very soon. We're also going to talk about two other stocks that Warren Buffett has been buying lately that are very safe stocks that will maintain your wealth and capital during times of market uncertainty, a stock market crash, or even an economic recession, and these stocks also offer a very good dividend. Now, these are the types of videos that members of this channel will get on a weekly basis, and they will also get it a week before any other subscriber, along with other perks. So if you want to become a member of the channel, remember to go and click the membership button next to the subscribe button to look at the perks if you want more videos like this one. So without further ado, here's the preview about the videos that I will be releasing to members only about the stocks that not only I am buying, but the stocks that I think and other financial institutions and professionals think will surge very soon. So with that being said, remember to go and smash that like button for more videos like this one, subscribe if you are new, comment down below your favorite stocks to buy, and what companies you want me to research if you're a member, and without further ado, let's jump right into today's story. So in our first article, we're going to be analyzing an article in which Goldman Sachs is advocating for their investors to buy two specific stocks which they believe could jump by around 90% in a short amount of time. So let's see exactly what stocks they are going to have us buy and what my opinion is on those particular companies. Well, to start off, the chief investment officer at Goldman Sachs actually says that it's preferable to buy stocks when the market is in overall FOMO, FUD, or in fear. And I 100% agree with him. We should be greedy when other people are fearful and fearful when other people are greedy, to quote Warren Buffett. So while the market is in somewhat fear or FOMO or FUD mode, we should buy undervalued stocks that we think could surge in the short term, and Goldman Sachs has identified two companies that could do just that. The first company we're going to talk about is Dole, ticker symbol DOLE, which trades for $8.86 per share, while professionals think that the company should be worth anywhere between $9 and $17 over the short term. This already indicates that professionals and experts in the stock community already dictate that the company is trading at somewhat of a discount right now, but why do they think that? Well, Goldman Sachs goes on to talk about how this company is undervalued and how we should buy this company because regardless of the current negative macroeconomic environment with higher inflation rate and rising interest rates, and that technically we are in a recession, consumers are still going to be buying things such as fruits and vegetables, which is something that Dole specializes in, and that's where they come in. They are an Ireland-based company whose headquarters is in Dublin, and they are literally the world's largest producer of fruits and vegetables. They offer over 300 products that are distributed in over 90 countries. So this is a gigantic company that has around 74,300 full-time and temporary employees that work across 162 different distribution and manufacturing centers that Dole owns. The company is also very strong financially, to where in Q2 of 2022, the company delivered revenues of $2.36 billion in just a single quarter, which would equate to around a 95% year-over-year increase. Now, although the estimate for their consensus revenues for Q2 of 2022 just missed Wall Street's estimates by around $20 million, where they were supposed to bring in $2.56 billion, their non-GAAP earnings per share came in at 44 cents per share, which means they obliterated Wall Street's expectations in regards of their non-GAAP EPS, which was only supposed to come in at 36 cents per share on the positive side, but clearly they decimated that projection, bringing in 44 cents per share on the positive side. And this is why a Goldman Sachs analyst, whose name is Adam Samuelson, thinks that the positives for this company definitely outweigh the risks. So the risk to reward ratio is in investors' benefits, where he says, and I quote, "While we recognize the guidance reduction and less linear earnings recovery is disappointing, we believe underperformance in its smallest business alongside FX headwinds should not fully overwhelm the generally solid performance in the balance of the business. With shares trading at 10% and 16% free cash flow yield, on our respective 2020 and 2023 estimates, risk to reward remains compelling in our view, particularly when considering the fresh vegetables losses and sizable working capital step up embedded in this year's FCF baseline, end quote. So overall, the analyst is saying that if we're weighing risk to reward, that this company has way more reward than it does risk, and potentially the company could surge by 90% because this particular stock professional believes that the DOLE share price could surge up to $17 per share, and that's his stock price target. So clearly he gives the stock a buy rating in which he believes that it could climb by around 91% higher in the next 12 months, which is absolutely phenomenal. If we look at some other forecasts by analysts, we can see that the current stock price trades for right now on an updated basis $8.83. However, the average price target is $16, while the low end price target is $15 and the high end price target is $17 per share, with two analysts covering this stock and they both give it a buy rating. So overall, I would say this is a pretty positive buying opportunity, at least for the short term, because the ability for it to increase 90% in the next 12 months is going to beat the majority of stocks on the market if this analyst turns out to be right. Another company that Goldman Sachs is advocating for its investors to buy is Melco Resorts and Entertainment, ticker symbol MLCO, which trades for $5.61 per share, while professionals think that the company is worth anywhere between $4.60 to $13.30 in the short term. So why is this one of the top Goldman Sachs picks right now? Well, basically, this is a casino company that has facilities over in Asia and Europe, where it owns 511 gaming tables, 572 gaming machines, and hundreds of different rooms, suites, villas, because it operates in a fantastic resort. Now, for casinos and resorts and companies like this, we can actually see how the lockdowns have negatively impacted these companies to where now they are trading on a very cheap basis. And due to the recent lockdowns, it might be a good time to buy this company on weakness, because the demand has surged for the amenities that this company offers, to where on a week-over-week basis has grown by around 43%. So clearly this company is making a gigantic comeback. However, over the past year, the stock price has been lower than investors expected. Also, there is fears of delisting various companies regarding delisting Chinese and Hong Kong-based companies if they fail to meet US audit standards and regulations. And that is still very apparent, and we've done a couple update videos on that, so again, keep this in the back of your mind. However, despite this, a Goldman Sachs analyst believes that this company is worth around $13 per share, which would imply a 12-month upside of 125%, where the analyst actually comments, and I quote, "While the overall operating environment remains fluid and timing for a resolution of the potential delisting risk is uncertain, we believe MLCO's fundamentals remain solid versus some of its peers, i.e., business recovery outside of Macau, less liquidity issue near term after several rounds of refinancing. At the current share price, the stock's valuation looks compelling," end quote. So overall, I agree with him, because this company could literally surge by 125%. The current stock price on an updated basis trades for $5.68, while the average price target for the company is $9.67, which would equate upside of around 70.25%. Other analysts believe the company could surge on the higher end to $13, and on the low end, it could settle at around $5 over the next year. Again, three analysts cover this company, one of them saying to hold, and two others advocating a buying opportunity. Now, I respect Goldman Sachs as an institution and these various professionals. However, in my personal opinion, if I had to choose between these companies, I would bet my money on DOLE. However, both of these companies are not the companies I am investing in right now. To get that information, you're going to have to become a member of this channel so I can show you my portfolio, the companies that I am buying, and some of the best opportunities in the market right now. Now, if you are more of a risk-averse investor, because these are clearly more risky investments with a large amount of upside, what type of companies is Warren Buffett buying right now? Well, I'm going to start off with a very well-known company called Johnson & Johnson, ticker symbol JNJ, which currently trades for $166 per share and 78 cents, while professionals think the company company's worth anywhere between $165 to $215 over the next 12 months. I am a huge fan of Johnson & Johnson, and although this is by no means a growth company, this company does offer a decent dividend, and it adds stability in your portfolio to where times of uncertainty and a stock market crash or a recession, this company is going to prevent your portfolio from losing too much money because it holds its value better than the majority of other stocks, particularly during times of uncertainty. Johnson & Johnson offers a multitude of business segments to where their pharmaceutical segment generates them the majority of their revenue. Around 55% of their revenue was in this particular segment, where it brought in $13.3 billion of revenue for the period ended on July 3rd. That's followed by their med tech segment, which brings them in $6.9 billion, which represents 29% of their overall revenue, which is closely followed by their consumer health segment, which brought them in $3.8 and a 16% revenue weight. Johnson & Johnson's medtech business is tied to a multitude of contracts with very prestigious hospitals, and this gives the company very stable and consistent revenue. So overall, Johnson & Johnson's financials have been steady over the last decade, which is the last 10 years, and it really doesn't look like anything's changed to where well into the future, the company's revenues look absolutely fantastic. Johnson & Johnson doesn't only stabilize the portfolio and prevents people and investors from losing money during times of uncertainty, but it also offers a decent dividend because it is a dividend king after all, because it has raised its dividends and its dividend yield and their payout 60 straight years in a row. Currently, the average dividend yield for J&J is 2.7%, which is very good. Also, I'd like to point out that during the same time that the S&P 500, which is a fantastic stock market benchmark, lost around 13% of its overall value, Johnson & Johnson only lost 2% of its value, which is more than made up by the overall dividend yield of 2.7%, and on top of this, they also offer a far more competitive dividend than the S&P 500, which only gives investors an average of around 1.5%. So clearly, this company has a very low beta. It maintains and retains its value very nicely, much better than the overall stock market, and it's just a fantastic foundational company to have in a well-diversified portfolio, and I personally own this company in my portfolio. The next company we're going to talk about is Kraft Heinz Company, ticker symbol KHC, which trades for $38.83 per share, while professionals think the company is worth anywhere between $34 and $48 over the next 12 months. So what makes this company a good buy? Why is Warren Buffett so infatuated with this company? Well, the first one is this company also performs very well despite a recession, a stock market crash, or economic uncertainty, very similar to Johnson & Johnson. However, this company really shows its strengths through the various brands that they own, such as Kraft Foods, Heinz, Jell-O, Kool-Aid, and other very popular names. This company also performs very well in times of inflation because consumers really don't have any choice but to buy various products from grocery stores that sell Kraft Foods products, Heinz, Jell-O, Kool-Aid, and other things like that, because consumers are still going to need to eat and buy these various products. The top of the line growth for the company increased by around 10%, and Kraft also has huge customers, with one of their main customers being Walmart. And this has allowed this company to generate very impressive operating profit in each of its past 4 quarters, to where they accumulated $3.2 billion worth of free cash flow, and they paid out around $2 billion worth of dividends from that free cash flow, to where Kraft Heinz offers a more competitive dividend than Johnson & Johnson on a dividend percentage yield basis of 4.2%. So again, these companies are absolutely fantastic, but if I had to compare both of these companies, I would put my money on Johnson & Johnson. So I hope that you all like this preview of the type of videos that I'm going to be giving to my members, or if you just want to support the channel and get some really cool perks, go and check out the membership to this channel for more videos like this one or other perks that I offer members. But if you don't want to become a member, that's all right. I will still be releasing videos like this one, just with less detail. So with that being said, remember to go and smash that like button right now, comment your thoughts down below, subscribe if you are new, and I'll see you in the next YT video.